What you're seeing on your screen right now is not the full truth about silver. It looks like a price, it moves like a price, and every headline treats it like a price. But it is only one version of reality. It is the paper version. And right now, in March 2026, that paper version is drifting further away from the physical truth than at any point in recent memory. Turn on any financial news outlet today, and the message is consistent. Silver is down. The Federal Reserve held rates. The dollar is firm. Macro conditions are unfavorable. The tone is calm, rational, and deceptively complete. It tells you everything you need to know, except for the one thing that matters most. Because the story being told is built entirely on paper market inputs. Futures prices, bond yields, currency strength, central bank language, all real, all relevant. But not the whole picture, not even close. What is missing is the physical side of the market. The side that doesn't trade in milliseconds, the side that doesn't react to headlines, the side that deals in actual metal, bars that must be moved, stored, delivered, and consumed. And right now, that physical side is telling a completely different story. On the surface, silver looks weak. It's trading around the mid-70s, down on the day, reacting exactly as you would expect in a higher for longer rate environment. Gold is holding up better, creating a divergence that confuses even experienced market watchers. People are asking whether silver is broken, whether the thesis is wrong, whether something fundamental has changed. But that confusion only exists if you're looking at one side of the market. Because underneath the paper price, something else is happening, something measurable, something documented, something that doesn't rely on interpretation or opinion. Delivery. In March alone, over 8,000 silver contracts have gone to delivery. Each contract represents 5,000 ounces. That's more than 41 million ounces of physical silver that didn't get rolled forward, didn't get cash settled, didn't disappear into a spreadsheet. It moved, it changed hands, it left the system. That number is not theoretical. It is not speculative. It is recorded, verifiable, and sitting in the exchange data for anyone willing to look beyond the headline price. To understand what that means, you have to understand how the system is supposed to work. The futures market exists to facilitate trading. Most participants never intend to take delivery. They trade exposure, not metal. Contracts are opened, closed, rolled, and offset. The assumption, the foundation of the entire structure, is that only a small fraction of participants will ever demand physical silver. That assumption is now under pressure, because when tens of millions of ounces are being taken out of the system in a single month, the math starts to change, the buffer starts to shrink, the margin for error disappears. At the beginning of March, the registered silver inventory, the metal actually available for delivery, was under 80 million ounces. That's the supply backing the entire delivery mechanism. And in just 1 month, more than half of that has been claimed. Think about that for a moment. Half the available supply gone through delivery in 30 days. And yet, the price is down. That's where the disconnect becomes impossible to ignore. Because if you only look at the paper market, the price movement makes perfect sense. The Fed holds rates, inflation remains sticky, the dollar strengthens, silver sells off. That's the model, that's the algorithm, that's what the system is designed to do. But the physical market doesn't run on that model. Industrial demand doesn't pause because of a press conference. Manufacturing contracts don't adjust because yields tick higher. A solar panel factory doesn't reduce its silver consumption by 1% because the market dropped 1% in a single session. The metal is still needed. The metal is still used. The metal still has to be delivered. And that's exactly what's happening. At the same time, the paper market is pushing prices lower. Physical buyers are stepping in and taking metal out. Not hypothetically, not eventually, now. One of the clearest examples of this comes from institutional behavior. On a day when silver was being sold aggressively in the futures market, a major bank issued delivery notices for a large quantity of silver. Another major institution stepped in and took a significant portion of that delivery. That decision wasn't made based on headlines. It wasn't emotional. It wasn't reactive. It was calculated. Because institutions with direct visibility into the system, into inventories, delivery flows, and open interest, are not guessing. They are acting on data. And when those institutions choose to take physical metal during a price decline, it sends a signal. Not a public one, not a loud one, but a precise one. It suggests that, from their perspective, the current price does not reflect the true value of the metal. This is where the structure of the market becomes critical to understand. There are two systems operating at the same time. The paper system processes enormous volumes of trading activity every day. Hundreds of millions of ounces change hands in contract form. Algorithms, hedge funds, and trading desks move in and out of positions based on macro signals, technical patterns, and short-term opportunities. The physical system operates on a completely different timeline. It is slower, heavier, and constrained by reality. Metal has to be mined, refined, transported, and stored. It cannot be created with a keystroke or erased with a trade. The link between these two systems is delivery. And when delivery starts to accelerate, the link tightens. Right now, that link is being stressed. Because above the shrinking physical inventory sits a massive amount of paper claims. Open interest in upcoming contracts represents hundreds of millions of ounces. Under normal conditions, most of that will roll forward. That's how the system survives. But if even a small percentage of those claims turn into delivery demands, the pressure increases rapidly. That's the setup. A declining physical buffer, elevated delivery demand, large open interest approaching notice day, and a paper price that is moving in the opposite direction. This is not a contradiction. It is a divergence. And divergences do not last forever. At some point, the two systems have to reconcile. Either the physical demand slows down or the price adjusts to reflect the scarcity. Right now, there's no evidence that physical demand is slowing. Industrial consumption remains strong. Supply constraints persist. Global inventories are not building. They are being drawn down across multiple exchanges and storage systems. At the same time, certain international markets are pricing silver at a premium relative to the paper price. That premium exists because the metal is needed, and the cost of not having it is higher than the cost of paying more. Under normal circumstances, arbitrage would close that gap. Metal would flow from lower-priced markets to higher-priced ones until equilibrium is restored. But barriers, logistical, regulatory, and structural, are limiting that flow. So the gap remains, and that gap represents opportunity for those who can access the metal at paper prices. This is known as the basis trade, the difference between paper and physical pricing. When that difference widens, it creates an incentive to acquire physical metal through the paper mechanism and benefit from the eventual convergence. That's what sophisticated participants are doing. They are not reacting to daily price moves. They are positioning for structural resolution. Because eventually, the system has to balance. The question is not whether it happens, but when. And that timing is increasingly focused on key dates in the delivery cycle. As contracts approach first notice day, participants must decide whether to roll forward or stand for delivery. That decision point forces the paper claims to confront physical reality. If the majority rolls, the system continues. If a larger than expected number stands, the pressure intensifies. Right now, the setup suggests that this decision point could be more significant than usual. Not because of speculation, but because of arithmetic. The numbers are what they are. Tens of millions of ounces already delivered, a shrinking pool of available inventory, a large amount of paper claims approaching the moment of decision, and a price that does not reflect that tension. This is why relying solely on the paper price can lead to confusion. It tells you what traders are doing in response to macro conditions. It does not tell you what is happening to the underlying asset. It does not show you the metal leaving the vault. It does not show you the accumulation by institutions. It does not show you the constraints in the physical supply chain. Those things exist outside the immediate feedback loop of the price, but they matter. In fact, they matter more over time, because while paper positions can be opened and closed instantly, physical movements have lasting impact. Once metal leaves the system, it is not easily replaced. It does not reappear because sentiment changes. It is gone until new supply enters, and that takes time. This is why the current situation is so unusual. You have a market where the visible signal, the price, is pointing one way, while the underlying mechanics are pointing another. That creates tension, and tension in markets eventually resolves, sometimes gradually, sometimes suddenly, but always based on the underlying reality. Right now, that reality is being documented in delivery data, inventory reports, and physical flows, not in headlines. So before reacting to a red candle or a negative news cycle, it's worth asking a simple question. What is actually happening to the metal? Because the answer to that question may tell you far more about the future than the price on your screen today. And right now, the answer is clear. The metal is moving. The inventory is shrinking. The demand is real, and the gap between perception and reality is growing. What happens when that gap closes is the only story that truly matters.